Welcome to the Deep Dive. We take the information you share with us and, well, get right to the core of it.
That's the plan.
Today, we're diving deep into a specific way of looking at stock trading. Specifically, how you might identify those really rare companies that become super performers.
That's right. And for this, we're drawing from key excerpts from Mark Minervini's book, Trade Like a Stock Market Wizard. I mean, it's built on years, decades, really, of his own research and market experience.
Okay, so our mission here is pretty clear. Let's unpack the main ideas from these sources. We want to give you a kind of shortcut to understanding the critical factors, the key signals this approach says are, well, absolutely essential for spotting these potential big winners. What are the real non-negotiables?
All right, let's get into it. The very first thing, and it's foundational, is a perspective shift. Trading isn't just a sport, or some hobby.
Not a quick buck scheme either.
Definitely not. It needs to be treated like a business, seriously, with dedication, study, practice, and discipline. Lots of discipline.
Right. So the goal isn't just hitting a lucky trade here and there. It's about consistently making quality choices. What to buy? Sure. But also when to buy it, and maybe even more importantly, when you need to sell it.
And that practice element is crucial. The source makes a great point. It's not just practice makes perfect. It's perfect. Practice makes perfect.
Yeah.
Meaning just doing the same thing over and over, especially if it's wrong, isn't going to help. You need to practice the right techniques, learn from mistakes, not just repeat them.
Okay, that makes sense. And that leads into the view on paper trading, right? This approach suggests it's, well, not quite the real deal.
Exactly. You can learn the mechanics, click the button, sure. But it completely misses the emotional element, the pressure, the feeling you get when actual money is at stake.
You need that real-world seasoning.
Yeah, getting used to trading for real, even small amounts, is key to building that emotional control you absolutely need.
Which brings us to maybe the toughest part.
Yeah.
It's not the market, it's you, yourself.
That's it. Success really hinges on controlling your own emotions. Things like greed, fear, ignorance, even hope when it's misplaced. You have to make rational decisions. And risk management is just vital, protecting your capital.
Okay, so mindset, discipline, understanding the personal challenge. Check. Where do we start looking for these opportunities then? This method puts a huge emphasis on timing. It talks about a stock's life cycle.
Yes, the price maturation cycle. Think of it like 4 distinct stages a stock generally moves through.
And knowing the stage is critical.
Absolutely fundamental. It tells you whether you should even consider being involved or if you should stay far, far away.
Okay, walk us through them. Stage 1.
Stage 1, neglect phase. Or consolidation. Basically, the stock isn't doing much. Volume is low. There's not much interest. The price just kind of drifts sideways.
Dead money, essentially.
Pretty much. The research calls it dead in the water. You want to avoid getting your capital stuck here. It's just a waste of time and opportunity. There's an Amgen chart example showing exactly this, just flatlining before the big move.
Got it. Avoid stage 1. So stage 2 must be where things get interesting.
That's the one. Stage 2. Advancing phase. Accumulation. This is where the uptrend really begins and gathers steam, often kicked off by good news, maybe a regulatory shift, or just the business outlook really improving.
And the big players start noticing.
Exactly. This is where institutions often begin building their positions, accumulating shares. It's the ideal stage for involvement.
So how do we spot stage 2? What are the signs?
Key signals. The price needs to break clearly above its 200-day moving average. That's a key long-term trend indicator.
The average price over roughly the last year of trading days.
Right. And crucially, that 200-day average itself needs to start trending upwards. Not flat, not pointing down, upwards.
Okay. Price above an upward sloping 200-day. What else?
Volume patterns are important.
Right.
You typically see volume increase on days the stock rallies and decrease on days it pulls back. Healthy sign. And the stock should be making higher highs and higher lows, a clear uptrend structure.
Like climbing stairs, not just bouncing around.
Precisely. The Amgen charts again show this transition perfectly breaking out as stage 1, establishing that stage 2 uptrend with all those characteristics lining up.
Okay, stage 2 is the goal. What happens next? Stage 3.
Stage 3, the topping phase. Distribution. This is where the strong uptrend starts to lose momentum. The price might still churn higher, sometimes on really high volume, but it struggles to make significant new ground.
Sounds like it's running out of steam.
It often is. This is where the smart money that got in earlier might start selling distributing their shares to buyers coming in late to the party, volatility often picks up. You really want to be stepping aside when a stock enters stage 3.
And then the inevitable, stage 4.
Stage 4, the declining phase. Capitulation. This is the downtrend. The stock price falls decisively below its 200-day moving average, which is now clearly trending downward.
Uh-oh.
Yeah, this is where you can see panic selling, sharp drops, sometimes accelerating declines. Holding a stock in stage 4 is precisely what this strategy aims to avoid at all costs.
The examples you mentioned, like Bank of America, Crocs, Vicker, they show pretty dramatic stage 4 declines, right?
Absolutely stark examples of what happens after a stock tops out and breaks down. Very quick, very damaging if you're still holding.
So the analogy, climbing a mountain.
It's a good one. Stage 2 is the climb up. That's where you want to be. Stage 3 is the peak, maybe a tricky plateau. Stage 4 is the dangerous descent.
Stick to the climb. Avoid the peak and definitely avoid the slide down.
That's the essence of it. Stay with stocks that have the wind at their back, the ones in clear stage 2 uptrends.
All right, now let's shift gears a bit and tackle something that trips a lot of people up. Valuation, specifically the PE ratio, price to earnings.
Ah, yes, the PE ratio.
The common wisdom is buy low PE, sell high PE, right? But this approach seems to, well, challenge that, especially for these super performer types.
It absolutely does. It's a key point. A low PE doesn't automatically mean a stock is cheap or a good buy. Sometimes it's low for a very good reason. Maybe growth has stalled or the company has serious problems. It could be a value trap.
Okay, so high PE isn't necessarily bad.
Paradoxically, no. In the context of these fast-growing super performers, a high PE can actually be a sign of strength. It reflects the market's optimism about future growth. Investors are willing to pay a premium for that rapid earnings acceleration.
Like the Yahoo example in the source, trading at what, over 900 times earnings at one point? That sounds insane.
It does sound crazy by traditional metrics, but it illustrates the concept of PE expansion. As a company's earnings growth really takes off and sentiment improves, the multiple the market is willing to pay for those earnings can expand dramatically.
So the PE ratio itself grows alongside the earnings.
Exactly. Home Depot is another example cited. Its PE went from the mid-20s up to 70 during its big run. That expansion adds fuel to the stock price rise.
So value isn't just numbers on a page.
Well, think about the Van Gogh painting analogy used in the source. Costs $40 to paint, sells for almost $50 million at auction. Value is complex. It involves perception, demand, scarcity.
And in stocks, the market often pays up for quality and that potential for explosive growth.
Precisely. So chasing a stock just because its PE looks low can be dangerous if the underlying business is weak or deteriorating. Remember, AIG low PE didn't stop it from collapsing.
So view the PE less as a strict, is it cheap, measure, and more like a sentiment gauge.
That's a good way to put it. A barometer of market optimism or pessimism about the company's future prospects. PE expansion signals high hopes. Contraction signals worry.
Okay, if PE isn't the main driver, what is the engine? What fuels these huge stock moves?
Now we're talking fundamentals. The research is crystal clear. It's strong, consistent earnings and sales growth. That's the fuel.
But it's not just any growth, is it? There's a specific nuance.
Right. The critical factor is acceleration. You're looking for earnings per share, the EPS, where the growth rate is actually increasing, quarter over quarter, year over year, getting faster.
Not just growing, but growing faster and faster.
Yes. Companies like F5 Networks, Vicker mentioned in the book, showed triple-digit percentage growth in their earnings during their best periods. That's the kind of rocket fuel we're talking about.
And beating analyst estimates matters too, right? Those earnings surprises.
Hugely important. When a company consistently reports earnings better than Wall Street expects, and then analysts have to raise their forecast for future quarters, that creates a really powerful positive momentum.
Like the Urban Outfitters example, where those positive surprises just kept pushing the stock higher.
Exactly. And consistency is also key. The best performers often string together multiple quarters, 4, 5, 6, sometimes more of this strong accelerating growth. Think Cisco, Home Depot again, Microsoft, Apollo Group, Green Mountain Coffee Roasters. They all had these amazing streaks.
But, okay, how do you know if that growth is, well, real, sustainable? How do you judge the quality of the earnings?
Excellent question. That's crucial. You need to look under the hood. Is the growth coming from the core business? Higher sales, expanding profit margins, better efficiency, lower costs.
As opposed to, what? Financial engineering.
Yeah, or things like one-time gains from selling assets, or maybe unusual accounting items. You want to be wary if earnings are boosted by things outside the main operations. The source uses Monster Beverage as an example of a company firing on all cylinders, growth coming from strong sales and margin improvement. That's quality.
And the warning sign is the opposite of acceleration, deceleration.
Absolutely. If that earnings growth rate starts to slow down, that's a major red flag. The engine is losing power. Dell Computer and Home Depot are used as examples where the stock price started to fall after their earnings growth began to decelerate. You have to watch for that slowdown.
So growth is the fuel, but accelerating quality growth is the super fuel.
Couldn't have said it better myself.
Okay, last major piece here. Once you understand the stages, the earnings engine, the source talks about following the leaders. What does that mean?
It means identifying and focusing on the stocks that are already demonstrating the most strength in the market, the ones breaking out to new highs ahead of everyone else, showing superior relative performance compared to the averages or their industry peers.
So you're looking for stocks that are already winning the race.
In a sense, yes. These leaders often attract the most attention from big institutional investors, the smart money. They frequently exhibit all the positive characteristics we've discussed: the right stage, the accelerating earnings, the potential PE expansion. Following them is like getting confirmation that you're looking in the right place.
And these leaders often show up early, like coming out of a correction.
Very often. They
Wait.
tend to bottom out and turn up before the general market does. Amgen and American Power Conversion were cited as examples leading out of the 1990 bear market. Chipotle did it after the 2010 dip. They established leadership early.
So look for relative strength, new highs, strong fundamentals. The examples like Amazon, Humana, Panera Bread, they all fit this mold during their runs.
Textbook examples of market leaders exhibiting those traits.
But it's not just about finding them, is it? It's also about watching how they act, the double-edged sword idea.
Exactly. This is critical. Just as leaders can signal the start of strength, their behavior can also be an early warning sign for the broader market, or at least for their own trend.
Oh, so?
If the stocks that have been leading the charge suddenly start to lag, if they show significant weakness or break down even while the overall market looks okay or is still trying to rally, that can be a sign of internal deterioration. The generals are retreating, even if the soldiers haven't noticed yet.
Wow. So you trust what the leading stocks are doing, maybe more than analyst opinions or news headlines?
That's a core principle here. Watch the price and volume action of these leaders very closely, especially how they react to earnings news or during market pullbacks. Do they hold up well, or do they falter?
Examples like Bank of America faltering before the 2008 crisis, or Vicker, Crocs, OpenTable showing sharp declines after topping out. Those are signals to heed.
Powerful signals. Their behavior tells a story. Trust what you see the leaders do.
Okay, so let's try and tie this all together. Finding these potential super performers based on this approach. It's not about getting lucky or finding secret tips.
Not at all. It's really a disciplined, systematic process. It involves doing the homework to find stocks in that prime stage 2 uptrend.
Not being scared off by a high PE if the growth story supports it, maybe even seeing it as a positive sign of potential expansion.
Right. And then rigorously checking the earnings. Is the growth strong? Is it accelerating? And is it quality growth from the core business?
And finally, confirming all that by seeing if the stock is acting like a market leader, showing that relative strength and attracting institutional attention.
Exactly. It's the combination, the confluence of all these factors lining up. No single element is enough. You need the stage, the engine, and the leadership confirmation.
When they all align, that's where the highest probability opportunities lie for those really significant gains. It's the story the stock is telling through its price, volume, and fundamentals.
That alignment is what you're searching for.
All right, so given everything we've unpacked today, understanding the market stages, focusing on accelerating earnings, following the leaders, here's a final thought to consider. If the so-called smart money, the big institutions, tend to sell or distribute stock when it enters stage 3 or starts showing real relative weakness, what does that tell you about the potential danger of just holding onto a stock because it seems cheap based on its PE, or simply because you hope it will go back up, especially after it's already had a very long run? What really stands out to you from all this?